Massey announces a bond sale. Should we be excited? Hi, in this video, I'm going to explain what bonds are and how it fits in your investment portfolio. So when you see breaking news like this, you'll be able to make an informed decision. Let's get into it. Hi, welcome back to my channel where we talk about investing on the Trinidad and Tobago stock market with the goal of financial independence. So as you can see, my portfolio for the first time since I've been uploading on YouTube, it has passed $500,000 Trinidad and Tobago dollars. It is now at a value of 504,764. My capital gain has finally turned positive. So the current unrealized capital gain value is plus 3,278. And of course, my estimated dividends this year is 24,457. Now, going back to the capital gains, what this value represents is that if I decide to today sell all of my stocks, I will get a profit of 3,278. And as I explained before in a previous video, the return on your investment, stock returns, has two components. And I think I'll have a separate video on this. The two components are dividends and capital gains. So, based on the year to date, we spoke about indices in a previous video. Right now, my holdings are performing at 1% year to date, whereas the Trinidad market, represented by the composite index, is currently at minus 2.2%. So, what does this mean? The stocks that I've chosen is performing better currently than the overall Trinidad and Tobago stock market. No, I'm not an experienced industry insider. I'm just looking at the information that's available to everyone, and I'm making informed decisions as to where I decide to invest in my stocks. So, what I would like to point out is that currently my portfolio does not contain bonds. And that is how we started this video, talking about bonds. But what are bonds? Let's dive in. A bond is essentially the government borrowing money from you. You lend the government a certain amount of money, and in return, the government promised to pay you back that amount after a specific period of time. The government will pay you back a little bit more than what you lent it. The bond itself is a promise by the government to pay you back a certain amount of money. This is known as the face value. The face value is the amount of money that the government is promising to pay you back at the end of maturity. When you buy a bond, you may pay a discount price and they will give you back an additional amount of money reaching the face value. The bond have different time frames of maturity, which is the time until the government pays you back. Maturities can range from as short as maybe 1 month to as long as 30 years or more. Different maturities result in different types of bonds. There are different ways that a bond provides benefits or interest. I'll just discuss two for simplicity. A bond that pays a coupon. These bonds have a face value, and on top of paying the face value at maturity, the government pays an additional sum of money in the form of coupons. For example, a bond might pay a percentage like 5% of the face value periodically, either semi-annually or annually, until maturity. And there are bonds that pay no coupons. These bonds just pay back the face value at the end of maturity. So there's no semi-annual or annual payments. So let's recap. A bond is basically a promise to pay you back money that you lent to a government or to a private company. It's a promise to pay you back the money after a period of time. So let's look at this example. This guy here lent the government money, $950. This is the bond price, and he received a bond. This bond will mature after 12 years. And at the end of the 12 years, the face value of this bond is $1,000. So after lending the government $950, he will receive $1,000 after 12 years, which is the maturity term. During those 12 years, the bond will pay this guy a coupon rate of 5% the face value. So either annually or semi-annually, this guy will receive 5% of 1,000, which is $50. So he will receive $50 every year for 12 years. And then at the end of the 12 years, he will receive $1,000. This is how a bond works. So let's have a look at an example of a bond issuance by the government of Trinidad and Tobago. So in this particular example, they had a bond auction on May 12th in 2016. I got this on the central bank website. And typically, they will give you an information memorandum giving you all the information of the bond issuance. How Trinidad government sells it sells its bonds using an auction. So let's go through it step by step. So what do we see here? So the government wants to raise $1,000 million. They are showing a fixed rate bond of 4.5%. So based on what we said before, the coupon rate is 4.5%. The maturity term of this bond, well, it's issued on 2016 and it's due in 2028. So it's a 12-year fixed term bond. Great. So we know what the coupon is and we know what the term is. What other information we can get? If you scroll down into the information, they're saying that applicants, so they're explaining how they sell the bonds and they have an electronic auction system. So they're saying that applicants must be for 1,000 face value or multiples of. So you can apply for 1,000, 2,000, 10,000, 20,000. And I believe I read somewhere that the maximum, I think I read it on the website, the maximum value for an individual is 100,000. So we know what the face value is. So we know the face value, we know the term, 12-year term, and we know the coupon rate. So they're going to give you 4.5% annually of the face value. So what's left? How much do you pay? There it is. A maximum allotment can be obtained through a non-competitive bid is 100,000. So that's the maximum you can get. Now, what's left is how much you are paying, the price of this bond. So when I was explaining, I showed the price of the bond to be $950. But in the Trinidad system, it's an auction. So you have to tell the government how much you are willing to pay for this bond of face value 1,000. So some people might say, okay, I want to pay $950. Another guy might say, I want to pay $960. I another individual might come in and say, well, I really, really need these bonds. So I am actually willing to pay a premium for these bonds. So I'm going to pay $1,010 for a bond. Now, this is serious. You can offer whatever price you want to pay for this bond because you know at the end of the period, you're going to get the face value plus during the period, you're going to get 4.5%. So, whatever this bond, whatever value that bond is to you, you will offer the government. And on the government side, of course, the government will look at the list of applicants, and then they will take the highest value and go down the list until all their bonds are sold. And this tends what to happen. When Trinidad issues bonds, the bonds are oversubscribed, meaning more people want these bonds than they have available to sell. And in this sort of environment, that sort of bond market, what tends to happen is that people who pay willing to pay a premium, which is people who are willing to pay either the face value or more, tends to get the bonds first, and then the government goes down the list. So you're not necessarily going to get the bond at a price of, let's say, 950 if there are more bids above 950, say 960, 970, 980. And that's how the government issues bonds. And the reason people want these investment instruments is because it's considered safe. I am guaranteed to make 4.5% every year for that 12-year term. That's essentially what bonds are. That's the benefit of a bond. A bond, especially a government bond, is the lowest risk investment you can come across. And if you saw my video with mutual funds, a lot of people who are investing in mutual funds, they might as well use that money and pay the government of Trinidad and Tobago, sorry, not pay, but lend the government of Trinidad and Tobago and get at least a guaranteed 4.5%, because 4.5% is good for that 12-year term. So I hope this is clear. So let me recap. In this particular case, the face value of the bond is 1,000. The coupon is 4.5%. The term is 12 years. And the price you're willing to pay is whatever price you're offering for the bond, because it's an auction system. And that's how Trinidad government tends to sell their government bonds. So another type of bond that's available on the Trinidad market is National Investment Fund bonds. Now, this is not a government bond. This fund is owned by the government, but it's under a holding company. So actually, the name is National Investment Fund Holding Company Limited. So it's a limited liability company owned by the government of Trinidad and Tobago. And they offer bonds to the public. Now, people might think, well, if it's a government owned company, then it's probably the bonds are as safe as government bonds. And this is not the case. And let me explain. Yes, the government owns this company. It's the only shareholder of this company. And they offer three types of bonds over 20 years at 6.6%, 12 years at 5.7%, and 12 years at 5.7%, and 5 years at 4.5%. So I know you guys are really cued into what I'm saying. So you'll see that, hey, if I'm getting a bond for 12 years at 5.7%, then this is clearly a better investment than the government bonds that I spoke to you before, because it was the same period of time. But in the case of the government bonds, it was 4.5%. But in this case, it's 5.7%. But let me explain. When you're investing in these instruments, you're putting slightly more risk. You're involving slightly more risk into your portfolio. because these are not government bonds. These are corporate bonds. So if I go to the About Us, I can see, so this holding company limited actually owns 5 assets from Republic, from One Caribbean Media, from West Indian Tobacco, from Angostura, and from Trinidad Generation Limited. So this company owns shares in these 5 companies, and based on the return of and the performance of these 5 companies, this entity is then going to pay its bondholders these percentages over this period of time. So I hope you're following this. This is not a government bond. It's a government owned company which possesses shares in these 5 different companies. And based on the performance and the returns from those 5 different companies, they will then pay their bondholders. This is essentially a corporate bond. A corporate bond basically is a private entity, a company, and you're lending money to this private entity. And based on the performance of this private entity, they are able to pay the bondholders over a fixed period of time. It involves more risk because the company can only pay the bondholders if they have the money to do so. And that's based on the performance of the company. So a government bond and a corporate bond are not in the same playing field. Governments, because governments can easily raise taxes to get more revenue, whereas a company will need to perform better to get to produce better products at a lower price and make larger profits in order to have money to pay their bondholders. So corporate bonds involve risk around the performance of the company, whereas a government bond basically is called the zero risk or very low risk investment because it's the government. And the government, at the end of the day, can do what they have to do to get revenue. They can introduce property tax, they can raise income tax, they can do all sorts of things to get additional revenue. So that's why government bonds are considered safe investments, whereas corporate bonds has a little bit more risk. However, a corporate bond is not as risky as shares in the corporation because in a corporate bond, the company is promising you this sort of return, whereas if you own shares in the company, you're not promised anything. You're just partaking in the profits of that company. So if I dive a little bit deeper into one of the bond instruments offered by NIF, we can see that the offering price is 100%. What that means is that the price of the bond is the face value of the bond. So, in fact, the face value of this bond is $1,000 and the price of the bond is $1,000. So the returns that goes back to the bondholders is just the coupon rate. And in this case, the coupon rate is 4.5%. So it will be 4.5% for the period of 5 years in this particular case. And yeah, that we covered face value, we covered coupon, and we covered the term, 5 years, and we covered the price that you'll be paying. However, as I explained before, this is a corporate bond. Even though the entity is owned by the government, it is based on the assets under the corporation, which are the 5 companies I listed: Angostura, Whitco, Republic, etc. Yeah? So let's move on to my last example. So we saw the news headlines: Massey is issuing bonds And the question is this a good investment? Now, this is my opinion, and I'm not a professional financial advisor. So I'm just giving you my thoughts when I read the article. So, what we have talked about so far, we have spoken about the face value of a bond, the coupon rate of the bond, the maturity term of that bond, and then, of course, as in the case of government bonds, what price are you willing to pay for that bond? But when I read the article on these Massy bonds, sorry, that they're offering, I don't see that information. They spoke about the the bond being issued. Let me zoom in a bit if you guys can see. Bonds will be issued. Let me highlight it. They say bonds will be issued in one series and will carry a tenure of 15 years. Okay, so we know what the term maturity is. We know that the bond will be repaid via equal semi-annual payments. So that's good. So we know the period of time. But actually, they say the principal due on the bond will be repaid via equal semi-annual payments following a 5-year moratorium. But they haven't actually told us what the coupon rate on that bond will be, whether they will have a coupon or not. Remember, there are two types. There are different types of bond. Some bonds will have a coupon, some bonds wouldn't. But they didn't give that information. So I don't know what's the coupon rate. I don't know what's the price of the bond. I don't know what the face value of the bond is. So for me, this announcement didn't really, get my heartbeat going because it didn't give much information. Maybe you will have to contact Massey to find out, or your broker to find out the details of this bond. But from what I'm seeing, the information in the public arena is not that much. So, from my perspective, I don't have enough information to give to make a value added decision on whether I am going to invest in these bonds. And I'm just taking it at face value from what I'm seeing. Now, philosophically, I have no intention of investing in corporate bonds. And the reason is simple. If I see a company like Massey and I think it's a high quality company, then why would I restrict? And this is how I view why would I restrict the potential return to a value? Whereas if I know this company is a high performing quality company, I can buy shares because I know this company is going to have huge profits in the same period of time, the same 15 years that they are issuing this bond for. So let's say the coupon rate on this bond is 4.5%. Then, yeah, if I buy that bond, I'm guaranteed a yield, a return on investment on around 4.5%. Let's see. Let's assume that the bond price and the face value price is the same. So therefore, the return on my investment will be the coupon rate, which in this example is 4.5%. So I know I'm guaranteed 4.5% return for the next 15 years. But if I buy Massey shares, the ceiling on my return on investment can be limitless because Massey has proven in the past that they can actually perform. And I think I'll get that information and I'll clip it in. But Massey has potential for huge performance, high returns in these next 15 years between now and 2040, because that's 15 years. And that's what I am banking on when I'm buying shares in Massey. I am banking on that this is a quality company and I will expect huge returns coming back to me via appreciation of their share price and steadily growing dividends over this 15 years. I am not going to settle for a bond because I know or I believe that Massey, I am banking on Massey performing very well within these next 15 years. But that's a risk I'm willing to take. And that's why when you invest in shares, you are taking a risk because you're not guaranteed anything. However, the ceiling in terms of your return is limitless. A bond is just a promise to pay you back. A corporate bond has additional risk because if Massey, let's say Massey flops in the next 5 years, they would not be able to pay their bondholders as well. So not only would shareholders be crying, but bondholders are crying as well if Massey flops. But I don't think that will happen. So let's look at the positive side. If Massey does extremely well in the next 15 years, the bondholders will get their 4.5% in my example. The bondholders will get their 4.5%, but the shareholders will get a lot more. It could get 20%, 30% if their performance reflects that sort of return. So I hope you see the difference. The bond is a fixed, guaranteed, in quotation marks, return, whereas if you invest in shares, returns are limitless. So I'm willing to take that risk. Now, if I was close to retirement, then maybe I would not be taking that risk. Maybe I will settle for a guaranteed return, so I will pay for bonds. But in my position right now, I am in my mid 40s. I'm willing to take some risk. And that's what I'm coming, that's why I'm investing in the Trinidad stock market, because I'm willing to take the risk that this market is going to rise exponentially in coming years. And I plan to ride that wave and receive the dividends and receive the returns on my investment. But the decision is yours at the end of the day. So, in terms of this Massey investment, they didn't give enough information that's in the public arena. So, I suggest you contact your broker or you contact the company directly and you get what's the bond price, what's the face value of these bonds, what's the coupon rate on these bonds. And based on that information, as we've stated in this video, you will be able to make an informed decision on whether you want to invest or not. Just an additional note, if you go to the central bank website, you will see that you are also able to purchase government bonds on the secondary bond market. This secondary bond market is what you see on the Trinidad and Tobago Stock Exchange. And in the case of J314, let's see, we know what the face value price is. The face value price is 1,000. Of course, the coupon rate is 4.25%, and the term is 25 years. And the price you pay, well, this is what is traded on the stock exchange. So the price itself, if you look at the charts, the price fluctuates because it's a secondary market, right? So it has buyers and it has sellers. And they have a way of calculating this on, yes, on the central bank website, which I wouldn't get into detail. But basically, the buyer pays the seller the value of the bond as well as the accrued interest because the coupon is being paid every year, right? So the best place to get further information on this is through your broker, and they can run different scenarios depending on how much you want, what you will have to pay based on the price on that day. So even though you don't get uh, through the you don't get government bonds directly through the auction, you still have the ability to get government bonds via the secondary market. However, you will have to pay a little bit more because, of course, people will be selling their bonds, right? So people who got through the auction will be selling their bonds on the secondary market at a slightly higher price. But it's a market, right? So it's it's a agreement between a buyer and a seller, and they'll settle on whatever price they settle on, and that's why the price fluctuates. So I just wanted to add that in. So if you're interested in the safer government bonds, but you don't get through via the auction directly with the central bank, you still have the ability to purchase government bonds on the secondary market through the Trinidad and Tobago Stock Exchange. And for further information, I suggest you contact your broker because I'm not going to cover that in this video. Thanks. Okay, folks, I hope I was able to clarify what bonds are and how they fit in your portfolio. Government bonds are a safe asset for fixed, reliable income, and corporate bonds promise higher returns but may come with higher risk. I personally do not use bonds in my portfolio right now, but if that changes, I'll let you guys know. One more thing, none of the information I provided to you about bonds will be helpful if you do not have any money to invest. Click on the link in the video and I will show you where I get my money to invest in my Trinidad stock portfolio. Take care. Bye for now.